Indices trade mixed ahead of the US interest rate decision at the top of the hour. Dollar moves lower as traders consider the possibility of a dovish statement from the FOMC. When we get the statement, we'll know for sure just how different the atmosphere was around the table at the meeting. What language will Jerome Powell use to highlight the change in recent economic data? Well, let's introduce our guests for us here in the studio this evening. Also off to New York in just a moment, but sitting beside me here is Tom Buffum. He's a senior investment analyst at Octopus. Tom, what are you expecting from today's decision?
Yeah, today is an interesting decision because it's the first one that's been live for a cut for a while. Our view is that cut's unlikely in line with the market, but it is possible, so especially after Draghi's comments yesterday. Yeah, OK, we'll cover those in just a few moments' time. Chris Beecham, IG Chief Market Analyst, what's your thought on what we're going to get today? Yeah, I think it's very much a case of not now but soon from the Fed, really, and watch that dot plot, which is, as we know, Powell's not favourite form of communication, but definitely one to keep an eye on, expecting Fed policy to soften in the near term, really. Yeah, hoping the dot plot's going to be out the window at some point. We'll have to see what happens there. Also with us from New York, as promised, is Chris Vecchio with us, with also his view of how he sees things developing today.
After declaring a patient wait-and-see approach at the most recent Fed meetings, it appears that the FOMC is set to signal the start of its rate cut cycle. Rates markets are currently discounting greater than an 80% chance of 225 basis point rate cuts this year, and a 55% chance of 3 cuts by June 2020. Given the rates pricing, the key question for today is, can the Fed clear the relatively high hurdles to come across as dovish? The odds of a dovish surprise appear low.
So now this is IGTV here to help you trade the FOMC announcement and the markets following the release at the top of the hour. Now, after hiking interest rates 4 times in 2018, the Federal Reserve has recently taken a more cautious approach to monetary policy this year. Concerns about the economic implications of President Trump's willingness to use trade tariffs in disputes with other countries means that the downside risks to growth are beginning to build. But what will be the Federal Open Market Committee's indications today? Now, economists seem to be expecting the Fed to signal precautionary rate cuts are in the offing, but markets are not pricing in any move today. GDP is holding up over 3%. Meanwhile, US jobs have continued to come onto the books, but it's not prompting any move up in wages. Why not, and could this change? Meanwhile, inflation is slowing. The key Fed inflation rates that it watches is the PCE. It is down, but nothing like the moves that we have seen in the Eurozone. Our markets seem to be favouring a 25 basis point rate cut in July, with 3 additional rate cuts over the next 12 months. However, there is an underlying strength in the US economy, and everyone will be watching the G20 in Japan to see if there's any easing in relations between the US and China. Now, before we catch up with some more detail with our guests here in the studio, I wanted to catch up with an interview my colleague Victoria Scholar undertook with Daniel Lecull, chief economist at Tressis, who shared his expectations of the Fed both tonight and for the rest of the year.
I think that the Fed does not need to cut rates at this moment, neither employment nor inflation. The PPI data that came out this week was actually decent. Therefore, there's absolutely no reason for the Fed to cut rates. I think it's more something that the market wants the Fed to do in order to continue to cement the inflated bubble of equities. However, what I think is that the Fed needs to build tools and needs to keep the powder dry in case the economy starts to really weaken. There are some signs there, but it's not yet something to worry about.
What is it that we should be focusing on in the meeting in terms of the presser? I mean, if you were there, what questions would you like answered?
Yeah, well, I think that the main question is about inflation, no? Because unemployment is fine. Unemployment is well within the target of the Fed, growth as well. In general, all of the economic figures are okay. So everything should tell us that the Fed would be in a position to normalize, to maybe not cut rates, but actually increase rates, hike rates, no? So the question is, why are they so concerned about an inflation rate that is not that bad either? And I think that is one of the things. What should we think about? I think that they will continue to have a dovish message. I think that what the Fed has been successfully passing on to markets is that they are willing to take action, but it's not the time yet. So probably we'll see, some elements of what other tools they could use in case of a downturn, whether they would be considering QE, all these things. But I think that in terms of action, they are not going to take any decisive action right away.
And do you think we should be cautious about the pace of change that we've seen from investors in terms of their expectations towards the Fed? Because it wasn't long ago that we were looking for up to 3 hikes this year, and there's been this major turnaround towards potentially 3 cuts. So how do we kind of interpret that, and what's driving it? Because, like you say, it's not really the data.
Yeah, I think investors want central banks to be extremely dovish, and investors like easy money. We all do, but it's dangerous. It is very, very dangerous to play this the worse the better, the worse the data, the better for us in terms of being more exposed to cyclicals, more exposed to let's say emerging markets, things that are very, very aggressive in terms of beta. So the general sense that I get is that investors have gone from being very aggressive about normalization of policy to extremely optimistic, at least optimistic in the sense of equity markets or of risky assets in terms of the policy. I think that central banks cannot just go out and give the message that the economy is doing well, that unemployment is improving, and that the growth is within expectations, and at the same time go ultra dovish. Because then that would send a very negative message actually to long-term investors that would say, hey, this does not compute. You cannot say on one side that things are going extremely well and at the same time be extremely dovish. Therefore, I think that investors are probably too aggressively exposed to cyclicals.
So we've got about 6 or 7 minutes until the decision at the top of the hour on US interest rates. Just want to quickly run through some of the markets. I think it's worth watching what's going on. First of all, the Dow Jones Industrial Average. We've seen this rise that we've had recently. Record highs at 26,900 back in October last year. And we are getting very close to this. We've still got a level of resistance to overcome, just above where we are. Current bid at 26,478. 26,690 is the high we saw here back in April this year. So looking ahead, we're really not too far away from record highs for the Dow Industrials. NASDAQ, a little bit further on behind. We've seen a little bit of a headwind for the tech sector in a number of areas recently, although a little bit more money has been going in recently. And you can see actually yesterday's candle was really quite a strong move up on the session. The other area of the market I think worth watching, and that is, well, euro dollar. But let's take a look at the dollar basket actually. The dollar basket has as part of its component parts, the major part of this, of course, is the euro dollar, but this is the way in which the dollar is moving against a basket of currencies today. It's a weekday going into that announcement today, but we have seen it lift off this. We've seen it have support down here at the 200-day moving average back, what was that, a couple of weeks ago when we saw the non-farm payroll data come through. Since then, there's been this move up, and a very strong day that we had back end of last week with the retail sales numbers indicating that there was this uptick, unexpected uptick. It wasn't a massive improvement on what was expected, but nonetheless, it was better than had been expected, indicating that perhaps maybe that the US economy is actually doing better than might otherwise be the case. The current bid at that at 96.88.9. Looking ahead to the top of the hour to get a steer on that as to whether or not there's any move on that and what the language is likely to be. Let's get some more indications now. What our guest here in the studio think about what we're expecting here at the top of the hour. Just want to quickly revisit your comments that you gave us at the very top, and just to embellish your thoughts on where we are and how the Fed is poised to move. We were hearing from Daniel Akal and Victoria Scholar talking about this big turnaround in sentiment over the last 3 or 4 months or so. From these interest rate rises we're expecting this year, all of a sudden that's now all dissipated and we're looking for interest rate cuts. What's been behind this and what's really happening in the markets to give an indication as to what's going on?
Yeah, I think the macro data has effectively weakened quite significantly from last year. So last year we're in a global upswing. Growth figures were good, inflation was rising, wages were strong. This year, some of that data's turned around, so we're seeing consumer consumer confidence, but mostly manufacturing confidence reducing. And inflation data has come back off 2% down to 1.6. And so the market is now questioning whether the Fed was right to hike as much as it has, and rightly questioning whether they should actually take their foot off the brake, off the pedal a little bit, and give the market some room to breathe.
Some of this, of course, the downside has been brought about by the White House position with regard China and the trade issues. How important is that? If that was resolved, how different, what sort of spin would that put into the FOMC discussions about interest rates?
Yeah, I think right now they're likely to wait pending that decision, because global tariffs haven't really come through. The second round of tariffs, which escalated in May, haven't really hit the data yet. So we saw the US tariffs escalate, or I think it was on the 3rd of May, and China retaliated towards the end of May. I think it was about the 30th of May. So that hasn't actually come through in the economic data. So this weakness in the data is actually pre those tariffs. The tariffs could definitely make that materially worse. That said, US trade isn't the predominant part of US GDP. So I think the Fed will bear that in mind, but it isn't the primary driver of their decision today.
Okay. Chris, in terms of some of these markets, just running through some of the recent gains that we've seen in equities, which have had a really decent run recently, what sort of effect is today's decision likely to have on these markets? If we do get a Fed that is in now patient mode on the way down, is that a positive for the market, or where do we go in terms of the activity around, let's say, the equities?
I think if the Fed shifts more towards the dovish camp, and if it joins the lead, if you like, set by the ECB yesterday, then it should be positive for equities. Over the longer term, we should note that in the time that Powell's been in charge of the FOMC, we've only had one positive update for US markets on the day of the Fed itself. So I'm not sure we should really be banking on some kind of huge rally today, even if we do get a fairly dovish Fed. A lot of this for today, I think, is priced in that infamous phrase. The reaction is likely to be limited. But I think moving forward, I think it would certainly support equity markets. The assumption that, yes, things might be weakening and trade wars certainly are playing hell with expectations for what might happen to the economy. But you've seen the Dow really right back at these key levels, not far away from these all-time highs. And of course, it's odd to be talking about cutting rates, or it seems odd to be talking about cutting rates when US stock markets are within spitting distance of new record highs. But that is where we are. Remember, the Fed's job is not to be looking in the rearview mirror, it's to be trying to guess what comes next. And sometimes they get it right, and sometimes they will get it wrong. And the sort of playbook, if you like, we're working with at the moment is, I think it's 95, when the Fed preemptively cut rates to try and avoid a recession. They got this magical soft landing, the economy didn't go into recession, and everything was hunky-dory afterwards. That's the assumption perhaps that people are going for. It probably won't work out that way, but I think that is what the Fed's trying to do. It's to get ahead of the game. They're seeing things that justify this more dovish stance, and that they're certainly echoing what they see, what the ECB sees in terms of a weaker global economic outlook.
Yeah. Tom, 2 minutes to go before the announcement. Just, you're a fixed income specialist. Just indicate exactly to us what all this means that's going on in the fixed income markets at the moment, because 6 or 8 months ago, we were looking at yields at around about 3% at the 10-year part of the curve. And people were saying, well, hang on, if it gets much more than this, it's a little bit of a worry for the Federal Reserve. But here we are now sitting, what are they, just over 2% at the moment? Yeah. What does this do to the market, and how does this help the Fed in its quest for easing and giving easier money?
Well, in a way, the markets have actually done part of the Fed's job for it. So the Fed is trying to ease monetary policy, make conditions easier for corporates, especially in the US. So the fact that rates have moved down by, like you say, about 1%, has meant that it's cheaper for them to raise funding through the debt markets, and potentially easier to raise equity. I mean, and we've seen that in the equity rally through the beginning of this year, where equities have been up 12+%, although dropped back from the highs more recently. However, there comes a point where the Fed has to follow through. Otherwise, all the easy gains that have been sort of gifted by the market pricing move will be undone as confidence gets lost and it becomes a self-fulfilling cycle.
Yeah. Very quickly, what does that low yield do to the dollar?
A low yield should weaken the dollar. I guess the other side of that is if it goes, if sentiment is so weak, the dollar will become a safe haven, so it could actually strengthen the dollar. So there's a bit of both, unfortunately, there. It's not clear.
Yeah. Okay. All right. We'll be back with you in just a couple of moments' time. We're waiting for the interest rate decision from the Federal Reserve. No change expected. And in fact, if we look at the interest rate futures markets, we were looking at something like around about 24%, I think it was, expectation for a move today, a cut today. So that is a minority. But in fact, the major balance was looking, in fact, not at today's meeting, but the 31st of July for any interest rate move. We will keep an eye on what's happening in the market. In fact, if we can bring up this chart here at the moment, which will give us a better idea as to what's going on. Let me just quickly bring up a chart which gives us a minute-by-minute indication. There we have a weakening dollar. Now, this is some of the headlines that we're getting through on this. The interest rates have been left as they are, and the longer-term picture sees economic growth slightly stronger in 2020. Jobless rate and inflation seen slightly lower. We know about that compared to March projections, but the Fed keeps a target interest rate steady at 2.25% to 2.5%. Nearly half of policymakers see lower rates as appropriate this year. We were talking about that and the indications that the Fed really wants to start thinking about a lower interest rate picture, notwithstanding what Tom was talking about and the effects of these lower bond yields. The Fed says uncertainties have increased regarding outlook for sustained economic expansion, I guess in part relating to the trade war. We still don't know how the US's relationship with Europe is going to go, and that, of course, is the other side of the coin so far as the European Central Bank is concerned. The Fed drops from its statement the previous language that it would be patient on future policy adjustments. Sorry, I'm not giving you a full picture there of what's happening with the dollar. Let me just switch this chart onto what's happening with S&P 500 and go onto a minute-by-minute chart to show you the effect of what's happening here. And you can see money going into this market at the moment as we see things stand as the markets move. The Fed says the economic activity is rising at a moderate rate. US short-term interest rate futures rise after this meeting. So what's been happening in the markets is a typical reaction. We've got no move in interest rates. What we do have is Chris Vecchio, I believe, standing by. No, we do not have Chris Vecchio in New York. I'm rather hoping that might actually have been with us. But we'll see if we can get up to speed with Chris in just a minute. But we do have Chris here in the studio. With us, Chris Beecham, IG Chief Market Analyst. Any thoughts on what you're seeing there? You're monitoring some of these headlines along with me.
Yes, and I think looking at the dot plot as well, the magic dot plot has shifted. So more Fed members expect lower rates over the course of the next couple of years. So we are, as expected, seeing this dovish shift from key members of the policy committee. It's a perfectly in-line statement, really, and it's a perfectly in-line move from the Fed. It is setting everyone up for some kind of move, either this side of the summer, probably more likely in September. Powell has a little job to convince, I think, the rest of the Fed to come with him on this. But it's clearly the committee that is shifting in this direction. So it's definitely one to keep up for.
Tom, just quickly catch up with one headline with you if we can. Fed says household spending appears to have picked up, but business fixed investment has been soft. This is interesting, actually, watching what's going on here in this dynamic. We're seeing all these jobs added recently in the economy, and they continue to be added. And the really surprising thing for me, and I mentioned this at the top, is the fact we're not seeing an uptick in wages. For whatever reason, don't know whether or not you can shed any light on that, but it's interesting looking at the consumer, seems to be driving things at the moment.
Yeah, I think that's fair. Wage inflation's at 3.1%, so wages have increased. I appreciate they're not at levels that we've seen in previous cycles towards the end of the cycle, but if I was in the Fed, I'd be relatively happy with wages running at that rate because that's above inflation. So people are getting more pounds in their pocket every single year. And so the consumer naturally does feel relatively strong. We saw that, you mentioned, Jerry, the consumer figures earlier in this segment. And so, yeah, that is a big beacon of strength. I guess it's the business side, the corporates, that are more feeling the pinch because they are paying slightly more wages to their workers. So that squeezes their margins a little bit. And they've been used to not paying so much, easy growth, and it feels like the easy yards have gone in this cycle. And from now, they're going to have to work hard to find growth rather than just cutting back costs. So I think that's the challenge.
Okay, all right, so I'll get back to you in a minute. I believe we might have Chris Vecchio on the line in New York. Chris, can you hear me?
I can hear you, Jeremy. How are you?
Chris, yeah, very good, thanks so much. Look, we've got this statement through, and I think actually Chris Beecham here in the studio is talking about steady as she goes. Anything you want to pull out particularly from what you've seen from the Federal Reserve statement just released?
Sure. It looks like that the Federal Reserve was able to meet the dovish hurdle that the markets had laid out before them. Taking a look at Eurodollar contracts right here on the screen, the spread between the June 2019 and 2020 contracts has moved out from about 66 basis points to 75 basis points, in effect saying that 9 more basis points are being priced out by markets over the next year. At this point in time, it looks like Eurodollars are pricing out a full 3 rate cuts over the next 12 months. The Fed change in stance here is more or less in line with what was anticipated, but now the rate hike cycle is officially finished.
Yeah. Let me just quickly run through a couple of charts with you if we can. Eurodollar, first of all, I think it's worth watching what's been happening with the dollar in the wake of this news. And if you've got that on your screen, let's see if we can get a euro-dollar trade. And where you see this going, I think, have you got is that a daily on there? I think you have, haven't you?
Yes, sir. With the Eurodollar chart here right now, it's been a lot of chop for the last few months, and what appeared to be a breakout of a bullish falling wedge situation back in the beginning of June has given way to perhaps a more sideways range trading environment now. If you take a look at the charts going back to the middle of April, prices have been contained more or less between about 111.10 and 113.25 here. Being that we're in the middle of this range, a little bit more price development would be appropriate before taking a directional bias. But again, the backdrop here, long-term bullish falling wedge here for Eurodollar, put in context of the DXY chart, which of course is showing a potential breakdown outside of the long-standing rising trend line from the March 2018 low. And you could have the precepts of a very significant US dollar top forming up right now.
Yeah, and of course the implications of that have interesting implications for the commodities markets. Gold specifically, we all know that amongst IG clients that there's a lot of interest in the gold market. In fact, I noticed on my daily chart here for gold that we've got these levels here. If we see this market closing at these levels, I think we've got pretty much the highest close since April last year. So on that dollar trade, just explain what's going on with gold.
Well, with gold right now, it's truly a bullish fundamental environment. Not only is the US dollar weakening, but US Treasury yields are weakening. And at a time when headline inflation is relatively stable, we are seeing an environment where real US yields are declining. Typically, when real US yields go down, gold benefits. So this combined backdrop of a softer dollar plus softer US real yields is proving to be quite beneficial for gold. According to the charts, the breakout of that bullish falling wedge that was in place at the start of the year did fulfill that initial thrust higher last week. Now, after a brief week off or so of rallying, it now appears that we're ready for a retest of that April 2018 high up at $1365.16.
Yeah. Okay. In terms of some of the other crosses for the dollar, we have been looking at some of the other interesting ones, especially some of those where we've seen a breakdown in some of the performance for the likes of the Australian dollar, but also the Japanese yen, because the yen has an interest in the markets as a safe haven currency. My guest here in the studio, Tom, was talking about the potential safe haven of the dollar, but what about the dollar-yen trade, and what's the likely move there, bearing in mind any potential, as I say, safety move into yen?
Well, Tom has a good point here. In an environment where there is a shift towards safety, both the dollar and the yen go into demand. But right now, where we see stocks going up and the dollar going down, you have this kind of balancing act where, on one hand, traders are seeking more risk insofar as that their interest rates will be lower moving out into the future. Fed is going to stay accommodative. On the other hand, this is pushing down the dollar. So is dollar yen the place that you want to be right now, where the yen is coming off due to the appeal of higher equity prices and the dollar is coming off due to the lack of appeal of the interest rate environment? Not necessarily. If I'm playing the US dollar, I'd much rather play against a currency like the Australian dollar or the New Zealand dollar, which is going to be a little bit more of a pure risk on, risk off play right now.
So in regard to the Aussie then, are you a seller of the Aussie dollar cross?
I think actually that you could be looking at long some of these emerging market currencies, these EMFX pairs right now. Australian dollar made an attempt at a false breakdown here earlier this week. It now appears that the range support is holding right around that 68.65 level. If this is a range that's going to be in place now due to the fact that the dollar is set to weaken upon this new shift in Fed policy, a return back towards the former swing highs we had earlier this month up in that 70 area would be appropriate.
Yeah. Chris, while we got you, actually, if I could ask you just to steer a course into sterling, because we've had some news out this evening. This is away from the Fed breaking news. The breaking news here in the UK is that there is another Conservative Party candidate that's dropped out of the running to be leader of the Conservative Party. It now seems like with Rory Stewart now having gone, it certainly seems like now we're getting ever closer to this potential full exit from the European Union without a deal. In other words, a no-deal Brexit. This is something that I know that sterling has really been frightened of. In terms of sterling trade, what are you following?
Right now, I'm keeping an eye on pound dollar here. We are currently flirting with a break of the trend line off of the absolute low that we saw back in October 2016, that pound flash crash we had post-Brexit vote. Right now, for the British pound, I think the key feature of the current Tory party leadership race is that all the frontrunners, including Rory Stewart himself, were in favor of a no-deal Brexit, if necessary. And then you weigh that against the fact that Jeremy Corbyn, the Labour Party leader, has been anti-EU for many decades now. It seems like it's a fait accompli for the UK to leave the EU on more difficult terms than, say, Theresa May's EU-UK withdrawal agreement. Right now, for the British pound, it's a difficult environment where measures of volatility are starting to increase. But I think that at least what the market's telling us, Boris Johnson's going to be the next prime minister, plain and simple.
Okay, all right. Look, Chris, we'll leave it there. Thanks for joining us. Chris Vecchio from the New York newsroom there for Daily FX, joining us in the wake of that interest rate decision from the Fed. A little bit of Brexit going on there as well. I want to catch up with Brexit with our guests here in the studio in just a couple of minutes' time. But let's persist, actually, if we can, Chris, with some of the news out. And talk about this dot plot. You mentioned the dot plot at the top. Dot plot's an interesting one because when you've got everybody expecting interest rate rises, I know you've got like Neil Kashkari, who's been right at the very bottom of the dot plot because he didn't want to see the interest rate rises that we've seen in the market. But when you get a swing round in sentiment like this, what's it do to the dot plot? Because all of a sudden you've got people with their view on the way up, all of a sudden they've now got a view on the way down.
And dot plot is interesting right now because you've got 8 expecting no cuts this year, but 7 of the committee expecting 2. So it is shifting very firmly in a dovish direction. The dot plot, I think, is the key takeaway here. The tinkering with the language is not so important, but it's the fact that 7 of the members of the committee do think that the time has come to begin cutting rates, not just once, but twice. So this is the beginnings of that dovish caucus that Jerome Powell needs to get at least one rate cut through, I think, the other side of the summer. And that's why you're seeing this positive reaction overall, I think, in risk assets.
Yeah, dot plot was something that we were talking about a lot over the last few years, but I know that there's some concern that Jerome Powell might actually steer away from that. How important is a dot plot to you? I mean, you, as I say, a fixed income specialist, but you have an eye on the rest of the markets.
Yeah, we keep an eye on it. It's more of an indication of what the Fed expects for the longer term outlook. At the end of the day, we think the chairman or chairwoman, as it was under Yellen, it has a big say in swaying the other committee members. It's not that their say goes, it's definitely a committee decision, but the dot plot isn't going to decide the future rate of interest rates. And I think they use it almost as a form of light forward guidance. And so in this way, the Fed is clearly indicating that they are now looking to cut and to go to cutting mode. And as Chris said, it's the end of the rate hiking cycle, at least for now. And you mentioned earlier in the 90s, the Fed actually cut through the middle of a cycle and then they went back to hiking mode, but it was after over a year. So I think best case, that's where we are right now.
Yeah. Okay, all right, back with you just a minute. I just want to quickly catch up with some of these markets again, revisit what's going on in the US before we take a step back and look at the Bank of England tomorrow, which is something else I do want to discuss with our guests here in the studio in just a moment's time. This is the minute-by-minute chart for the dollar basket. So we saw, excuse me, initial reaction on the way down, but since then we've seen an opportunity to buy back into these markets. Do you call that a double bottom? Well, yeah, possibly. If you do, from where you are at the moment to 96.65, you'd be looking to take a bid up to around about the 96.80 level. We're talking minutiae here, of course. This is a minute-by-minute chart. So the general thrust of things at the moment is that you've got this dollar remaining on the way down. I think the more interesting trade at the moment is around what's happening on the equity markets, because we have seen now today a new strike higher. And in fact, we closed at these levels. It'll be the highest close of the Dow since the 3rd of May. And it's similar sort of trade as well around the S&P 500. This is the minute-by-minute trade. Again, going back to the daily trade, you get a better idea as to the performance. In fact, we haven't seen a new intraday high on the S&P. The broader market hasn't performed as strongly as we've seen the Dow. The Nasdaq, this is the Nasdaq performance. Money coming off after that recent spike higher. Back to the daily chart, and again, like the S&P, we haven't seen a new intraday high there. But broadly speaking, you can see this as a trend you really shouldn't be getting in the way of. And if you're trading long on these markets, your stop would go below some of the recent price action at around about the 73.70 level. Current bid at 76.50 on the Nasdaq. Be interesting to see whether or not we wake up tomorrow and we find out actually ultimately the the Nasdaq has moved over close to that 78.60 level, which were the highs we saw back on the 25th of April. Now, let's just quickly, as I say, stand back and take a look now at this point on from here and switch the focus from the Federal Reserve onto the Bank of England. Tom, tomorrow, Bank of England, it's not an inflation forecast, not an inflation date, is it, tomorrow, if we don't get a quarterly inflation report. But what are you expecting in terms of the guidance from the Bank of England?
So I think the Bank of England are in quite a difficult position. The curve is currently reasonably steep, especially relative to the US curve, but the UK economic data is actually weaker. So they want to keep that sort of shape of the curve, and so they'll want to sound hawkish, but they definitely won't be hiking. I mean, our view is that the Bank of England is more likely to cut before they next hike, but that's not what's priced into the curve. So our expectation is just they'll try and sound hawkish, but not do anything.
How much of that potential cut is wrapped up in a no-deal Brexit?
I think if we go to a no-deal Brexit, we're probably back to QE and possibly several cuts. Because we saw a cut immediately after the Brexit vote when nothing, in fact, had actually happened at that point. So the Bank of England is very ready to act. I think a no-deal Brexit is very scary scenario for the Bank of England.
OK, so if we get a good deal, or indeed a can that's kicked down the road again, you still think the Bank of England's got a cut in mind rather than a rise?
Potentially not, but then the economic data is getting weaker, and so you can't ignore that part of the market. And so I think what will happen there is Carney will wait and see and hope the data improves as business investment comes back to the UK. But that's far from a guarantee, because it's likely that we have a transition deal, business investment still remains uncertain, and so actually we may not see the bounce that a lot of people are hoping for.
Yeah. Chris, how do you trade this announcement tomorrow? And what's in your mind for the Bank of England?
I think, yes, it's a more cautious outlook for the Bank of England that continues to prevail. I think you still see a bit more near-term strength in the pound. The Boris premiership is probably nailed on at this point, so a lot of that is factored into the price as well. You've seen the pound shoot higher over the past couple of days on this more dovish shift from the Fed. The question is if it can sustain, I think, these gains over the longer term. It's certainly been losing ground. We thought sterling was bottoming out over the course of the last 6 months, and then really this drop back towards 126, 125 has really sort of changed that view, I think, and confirms that the pound should continue to remain under pressure because of this political uncertainty.
Let's keep the chart up and switch it on to sterling against the euro. This fall here we had back from was at 117.68. This is sterling euro, so we're talking here about this is the value of the euro, so 117.68 all the way on the way down here. I think this is a record run on the downside for sterling against the euro since the start of the European single currency. Since then we've seen a further drop, and this news out today, Chris, that we've seen Rory Stewart lose out to I think perhaps possibly maybe a more Brexit no-deal camp, I think, overall. But nonetheless, we got sterling up today against the euro. What's the trade around sterling euro?
I think you still see some near-term upside, really. Mario Draghi's really put the weakness against the euro on this basis with its shift earlier in the week, that policy speech, which has essentially given everyone an expectation that the ECB will do something fairly substantial within the next couple of meetings, if not as soon as July. And as a result, I think you do see some short-term upside for the pound against the euro.
Tom, very quickly, you talked about the ECB. Oh, actually, I did think about discussing this, but let's talk very quickly about ECB from your position. What are your thoughts, especially on from what, as Chris was saying, Mario Draghi the other day, and potentially opening the taps again for easing?
Yeah, we were a little bit surprised by that announcement. I think Draghi is leaving, obviously, before the end of the year, and so while he has credibility, the question is who's going to take over and what will they do going forward? So I think he will be loath to put any big action in place, especially when his predecessor will have to endorse that and will put them in a more difficult spot and not give them the flexibility to put the monetary policy in they want. So it could be very interesting next few meetings for the ECB, I think.
Okay, all right, gentlemen, thanks indeed there for joining us. So that's it for this show, and taking you through that interest rate decision from the Federal Reserve. No change in interest rates this time around. It's really all a question now as to how the economic data comes through and whether or not that'll mean that there could well be an acceleration of what we've now been talking about and potential cuts in interest rates at later meetings. Tom Buffon was from Octopus Investments, and Chris Beecham with us here as IG's Chief Market Analyst. Also hearing as well from Chris Vecchio, Senior FX Strategist at Daily FX. Don't forget that we are back tomorrow morning, first thing 7:30 a.m. Mark Oswald will be joined by Victoria Scholar tomorrow morning for the early morning call for clients, and we'll be live as well at 10:30 as usual for charting the markets, and I'll be live as well at 5 to 12 tomorrow for that interest rate decision from the Bank of England. Next interest rate decision from the US Federal Reserve is at the back end of July. Of course, we'll be covering that as well, but a lot of water to pass under the bridge before then. My thanks once again to our guests here in the studio, and join us again tomorrow morning at 7:30.